that you've seen before. I am no longer in practice after 35 years. So while I'm still very closely following tax law for the benefit of teaching my students, I have to admit I'm very glad I'm no longer in practice and have to fully implement some of the things that have been dealt to us in the past several years. So keep that in mind, please. The other thing I'd like to have you think about is that we are committed here at TIPI to diversity, equity, and inclusion, and that includes diversity of thought on political perspectives. It's really hard to separate talking about politics when you're talking about policy. So if I do my job, you won't know which way I'm leaning, and we'll just go from there. The agenda that I've set up for you today is to first look back at where we've come from in the past handful of years that have been a nightmare for us on many fronts. I'd like to give you an overview of what Congress did accomplish in the 117th Congress. A stopping point will be to tell you what's going on at the IRS, because that's very much bookended between what Congress did last session and what it's planning to do this session. I'd like to give you a state income tax update. It's not just the federal government that has been very busy. And then finally, we'll do a look forward, and I'll put some things on your radar screen to think about as we move into the future. So let's start with the look back. I'm going to take you all the way back to the Tax Cuts and Jobs Act, known as TCJA of 2017. I tell my students this was President Trump's Christmas present to the American taxpayers. It became effective in general January 1st of 2018. We also had several layers of COVID legislation. And then finally, after the election of President Biden, he delivered to us his Build Back Better agenda. So the Tax Cuts and Jobs Act of 2017 had two major buckets. Provisions affecting corporations, and then those affecting individuals. The flagship provision when the act was passed by Congress was lowering the corporate income tax rate from 35% to 21%. And notice that change is permanent. There is no expiration date unless Congress decides to do something going forward. Several of the things that I have on the screen here, I'm going to be talking about as we go through the presentation. So I want to give you an overview of what those were. If you were organized as a C Corp, or a taxpayer was organized as a C Corp, again, they got the benefit of that rate reduction to 21%. If you were operating your business in what we call a flow-through entity, a sole proprietorship, an S Corp partnership, all of the income of the business would flow through primarily to individual taxpayers and could be taxed as high as 37%, which you can see down below is the rate that's in place right now for individuals. Businesses that were in flow-through entities said, hey, that's not fair. C Corps are getting 21%. So what Congress did is they added, and I don't want to talk about code sections, but it's often referred to this way, so I want you to have that in your head. The Section 199 Cap A QBI deduction. So this deduction was intended to give individuals a deduction to mitigate and really put them on equal footing with C Corps that were being taxed at the 21% rate. Notice I don't have permanent behind that provision. I also don't have permanent behind the other three. Bonus depreciation is a provision that gave businesses the ability to acquire capital assets that would normally be set up as depreciable or amortizable assets and recover the cost over time. Bonus depreciation allows taxpayers, if they have qualifying property, and I'm going to be very general here and say it's generally not real estate, when they acquire those investments in property, plant, equipment, they can just expense them immediately in the first year. So significant tax deductions and tax savings. In addition, for companies who are involved with research and development activities, the tax bill provided that taxpayers could write those expenses off right away as well. They still had the option to capitalize them and amortize them over time, but if they wanted to take the expense deduction and save taxes, it was available. One thing that affected corporate or businesses was a limitation on the interest expense deduction. Congress was concerned that they needed to pay for this tax bill, and they found that if they limited the interest expense deduction for business debt, there was a way to generate some revenue. So they put a cap. Again, the code section is 163J. They put a cap on the amount of interest that could be deducted. And again, this provision was not permanent, and I'll talk about it a little bit more as we go further. In the individual side of things, the rates were reduced, not as much, but from 39.6 to 37%. The deduction for personal exemptions and dependent exemptions was completely eliminated. You might remember that being about a $4,000 deduction, and I'm going to take a traditional family with mom and dad and one child. There would be roughly $12,000 worth of deductions to that family. That deduction was eliminated. So Congress, again, tried to mitigate the effect of that and increased the standard deduction for a married filing joint couple by about $12,000 to $13,000 to equalize it. So that family of three was in pretty good shape. But if you had more than one child, I had a client that had 6 children, they certainly did not come out in an equal footing. They were concerned about the impact of the standard deduction, loss of credit, personal exemptions, and so forth. So there was an increase in the child tax credit. It was actually doubled. Another very controversial provision was the $10,000 cap on the deduction for state income taxes. This was very political. Most of the blue states, Democratic states, are known to be the higher income tax states on the state side. The Republicans said, we are tired of having the Democrats get huge deductions for their state income taxes that costs everybody money. So we're going to put a $10,000 cap on the deduction for, I'm going to call them the blue states. There's been ongoing controversy about that. Keep in mind, again, I don't have permanent behind any of the provisions for individuals. So it will revert back, and I'll talk about the timeline for that a bit later as well. A big ticket item was that if you were concerned about paying estate taxes when you die, the dreaded death tax, the lifetime exemption, sometimes it's called a credit, essentially said that if you had an estate worth $5.6 million, you would pay no estate tax. And that was given to both, in a traditional family, a husband and a wife. So both spouses got that. I call it coupon. The tax bill increased that. It actually doubled it to 11.2 million, which essentially wiped out a lot of taxpayers from having to worry about having any estate tax consequences. Fast forward here to the legislation we had under COVID. I won't go into it in detail, but you can see the first bill was in March of 20 when the pandemic really got a hold of the country and the world. In late December of 2020, Congress decided they needed a little bit more boost to help taxpayers. And then in the spring of 21, the final COVID plan was passed. To refresh your memory very quickly, if you were an individual, you may have benefited from the stimulus checks, which came out in 3 batches, $1,200, $1,600, $1,400. I know some people are still waiting for their checks, clearly a problem, although I haven't heard a lot of people have that problem. Because so many people lost their jobs due to COVID, unemployment benefits were increased, and everyone was wildly happy until they realized that unemployment benefits were taxable. So in a flurry, right before the filing deadline, Congress made a change and said that any unemployment benefits, $10,200 or less, would not be taxable to provide most people some relief. There were tax credits to help families with children, working families that needed to have daycare. So many people were ill under COVID and had insurance issues that the medical expense deduction was increased slightly for those who had large amounts of uninsured medical expenses. In addition, a lot of people stood by and said, we want to help those people in need. So the cash contribution limit as a percentage of your adjusted gross income, AGI, was lifted from 60% to 100%. In addition, for those taxpayers who don't itemize on their individual returns, they were given a very small non-itemized deduction for charitable giving. A lot of people were having trouble servicing their debt, whether it was their home mortgage or student loans. So a provision was put into place that if you had home mortgage debt that was discharged, up to $750,000 of debt could be discharged and you would not have taxable income ramifications. Student loans, in essence, a moratorium was placed on student loans, saying that students did not have to pay any of their loans, including interest back, for a period of time. And then finally, because people were unemployed, they were concerned about how they were going to pay for groceries. So some people chose to dive into their retirement plans. If they did need to go into the retirement plans before they turned to the magic age of 59 and a half, they would have had a penalty. That penalty was waived. So again, if they had to dive into their plans early, the early withdrawal penalty was waived. And then finally, some people were concerned that if they were already in distribution mode for their retirement plans, with the impact of the economy on the market, they didn't want to cash out and take distributions while the value of their retirement plans was low. On the business side, a lot of loans, Paycheck Protection Program loans, grants for restaurants to help them stay afloat. A lot of these provisions were things that encouraged businesses to support their employees and their families and to keep them employed if they could. There were also some increases in deductions for businesses, charitable contributions, the limitations that might otherwise exist for net operating losses, what we call excess business losses, were waived or lifted. The interest expense deduction that I referenced earlier was set to have a cap that was lowered, and they eased that restriction as well. And then finally, again, to keep restaurants in business, the rule that said if you had a business meal, you could only deduct 50% of it, that 50% limit was eliminated. So any business meals were fully deductible, again, in an effort to support the restaurant industry. President Biden was elected during this time and laid out a three-part plan that he called the Build Back Better agenda. The first of the three prongs was the American Rescue Plan, which we've talked about. He also outlined the American Jobs Plan. That was the infrastructure plan, if you remember it better that way, and the American Families Plan, which is a focus on providing economic stability to America's families and their children. The American Jobs Plan had some corporate tax reforms in it. Biden's plan was interested in reversing the Trump reduction in corporate tax rates, not all the way, but bringing them back up from 21% to 28%. When President Trump's bill was passed, part of the provisions were intended to bring companies back to US soil, companies who had left the US in pursuit of lower tax rates. Biden was concerned that some of those reforms did not play out as they were intended to, or they needed to be strengthened. In addition, Biden was concerned that large corporations, primarily publicly traded corporations, showed billions of dollars of income on their financial statements, which are prepared according to generally accepted accounting principles. And yet, when they converted that financial income to taxable income, they were able to zero out their taxable income or have enough credits so they paid no tax liability. Very concerned about that. Again, he had a big focus on infrastructure, and he was going to have implementation of that occur through a variety of credits and also federal subsidies of state and local infrastructure bond that would finance infrastructure at the state level. And then finally, saving the planet, his clean energy initiatives. The American Families Plan was, again, to provide economic security to America's workers and their families. The top marginal rate of 37% was going to go back up to what it was pre-Trump, 39.6%. Biden was also concerned that wealthy taxpayers were getting preferential tax treatment because a lot of their income came from capital gains and qualified dividends. So the proposal was to eliminate the 0-15 preferential rate brackets and leave only the 20% preferential rate bracket for capital gains and dividend income. In addition, Biden was concerned that when people die, they may be subjected to estate tax, but regardless of that, any assets were increased in value from their original basis or cost to the the taxpayer who had died. They were stepped up to fair market value, in essence, allowing all the appreciation to escape taxation. Finally, he was concerned, you may have heard about the carried interest tax loophole. This was allowing what were perceived to be wealthy taxpayers who were providing services from having what would be compensation for services rendered, which would be subjected to the ordinary income rates as high as 37, 39%, and instead having them receive preferential treatment. He wanted to eliminate that. So where are we as the result of the last Congress? Again, we've talked about the American Rescue Plan in the spring of 21. There were actually 3 more, I'm going to call them tax bills, bills that had tax implications, and we'll go through each one of those one by one. So the Infrastructure Investment and Jobs Act was passed in November of 2021. You may recall, again, that this was Biden's big flagship campaign promise. It had a price tag of $1.2 trillion. It also increased the current budget by $550 billion, so that was outside the 1.2. And ways to pay for that, among others, digital assets, whether you call it cryptocurrency, virtual currency, NFT, non-fungible tokens, all of that was rearing its ugly head. The IRS and Congress had been aware that people were starting to invest and use cryptocurrency as part of their investment portfolio and also to conduct business. And there was concern that a lot of this activity was going under the radar screen and escaping taxation. So there were some reporting requirements. Everyone's familiar that your employer has to report your wages on a W-2. Anyone dealing, and I'm going to use that term very loosely, in cryptocurrency had reporting requirements to let the government know that certain transactions were occurring. The IRS was supposed to issue regulations. You can imagine this is an area that's very complicated. And the IRS actually delayed issuing final regulations. And then what we've had most recently happen is the FTX debacle, where FTX went bankrupt. Several people who had maybe quit their jobs because they'd made so much money through cryptocurrency suddenly found themselves with cryptocurrency that was maybe essentially worthless. The other tax provisions in the infrastructure bill concerned clean energy and highway taxes. So a whole list of electric vehicle credits for manufacturers and purchasers were introduced, and also energy efficiency for homes and commercial businesses. The Inflation Reduction Act followed in August of 2022, and the major pieces of this legislation were to get at Biden's concern that publicly traded companies were reporting fabulous earnings on their financial statements, but paying little to no tax. So what we have now is something called, and it's a mouthful, the 15% corporate minimum tax on book income. What does that mean? What it means is that corporations would look at their financial statement income and pay tax at a 15% rate on that financial income. So they'd no longer have their cake and eat it too. If they're going to have high financial statement income, tax will be paid. The threshold that's been set on that is for corporations that have gross receipts over a 3-year moving average of in excess of $1 billion. So the very large publicly traded companies would be subjected to that. One of the other things that President Trump's tax bill hoped to achieve by giving all of the corporate savings out to corporations was that the trickle-down effect that President Reagan was known for would occur. So tax savings at the corporate level would result in investment in manufacturing and jobs. Everyone would eventually be so happy, in the lower parts of the economy, that we wouldn't have to worry about running deficits with all of the tax cuts that were handed out in Trump's bill. One of the things that happened, instead of companies investing in manufacturing plants and providing jobs and so forth, they took some of the cash that they weren't paying to the federal government in taxes, and they either paid highly compensated executives more bonuses and incentives, they paid higher dividends to their shareholders, and in some cases, they actually pursued stock buybacks so that they would change the value of their stocks, and shareholders would feel better about their rates of return and so forth. So again, identifying that as a concern, the Inflation Reduction Act imposes a 1% excise tax, not an income tax, an excise tax on the dollar amount of stock buybacks that a company might be engaging in. The final piece of the Inflation Reduction Act that has received a lot of attention is an $80 billion funding package for the IRS. The two components that were generally talked about were the IRS is still using infrastructure on the technology side. I don't know how much of this is true, but back to the 1960s, old computer equipment that needed to be updated and modernized. In addition, there was funding for enforcement, and that has given a lot of people some heartburn. I'll flesh that out a little bit in a few more slides. Finally, in December of 2020, we got the SECURE Act, and that stands for Setting Up Every Community for Retirement Enhancement. There was a SECURE 2.0. Back in 19, we saw SECURE 1.0. SECURE 2.0 is full of goodies for employers and employees who are interested in saving for retirement. The list includes, instead of an employee joining a company and having to sign up to participate in a retirement plan, they will automatically be enrolled. It'll be required that they are automatically be enrolled, and they have to elect out. So a way to maybe indirectly get people to be more inclined to save. The required minimum distribution for taking money out of your retirement accounts was increased for 2023 to age 73. And by the year 2033, it will go all the way up to age 75. Starter 401k plans are simpler plans for small employers to be able to provide 401k plans to their employees. Catch-up contributions for older workers have been enhanced, and they'll start to be indexed for inflation. There are provisions that will allow you, this is my term, to piggy bank for emergency savings in case you have to make withdrawal if something should happen in your life. The Savers Credit is basically a federal match. If taxpayers choose to participate in retirement plans, the federal government will give you a tax credit up to a certain amount for contributions that you make. Student loan payment. Again, we all know students are in trouble with student loans. We know there's a moratorium, but as students join the workforce and have to start servicing their student loans, payments that they make against their debt, an employer can look at those payments and match the amounts that are being paid and put those amounts into retirement plans. Prior to Secure 2.0, any employer matches would go into a traditional IRA, which generally means it would be taxable upon distribution. Secure 2.0 now adds a provision where employers can match employee contributions into a Roth 401k, which, if you're familiar with Roths, mean that there won't be tax consequences when the distributions are taken out. One of the things I want to caution you about, you saw up above that the increase in age 75 won't happen for 10 more years. A lot of the provisions in Secure 2.0 won't kick in until after 2023. Anything could happen by the time the effective date of those occur. So while I think it's all really great news, you need to stay closely tuned in to see if these effective dates actually come into play. After those tax bills, the 117th Congress, after the midterms, basically had a stalemate at year end, where there were things that had bipartisan support, but the Democrats used the child tax credit as a way to hold out and keep Congress from reaching any kind of consensus and passing law. So the things that had bipartisan support, I talked earlier about President Trump's provision that allowed companies that engaged in research and development to fully deduct expenses incurred rather than capitalize them. That had a phase out. So effective January 1st of 2022, the beginning of last year, that rule was going to change so that taxpayers could no longer expense R&D, they would have to capitalize and amortize. In a similar fashion, the interest expense deduction was going to be lowered. Without getting technical, the threshold was based on EBITDA, meaning that depreciation that you deducted was added back to increase the ceiling on what you were able to deduct in interest expense. Again, effective January 1st of 2022, that was going to convert to EBIT. So if you had depreciation, that would no longer help lift the ceiling on the amount of business interest you could deduct. This is happening at a very bad time with interest rates going up. So a lot of controversy about that. Finally, bonus depreciation, that immediate expensing, it was set at 100%, and in President Trump's bill, it was scheduled to ratchet down over time. The first ratchet down was going to occur January 1st of 2023. It would go from 100% expensing to only 80%. None of these provisions were adjusted in terms of the timeline. So taxpayers, primarily business taxpayers, have been left with a huge limbo situation. They hoped that Congress would extend these so that they didn't have to convert everything for 2022. There's still talk that Congress might extend them, but we don't know if it'll be retroactive or prospective. So we always say that having two sets of books is a bad thing, but frankly, a lot of companies have had to keep their financials internally using both methods because they have to be able to turn on a dime if Congress should act. Let's take a breather here and talk about the Treasury Department, which includes the IRS. I'll drill down a little bit more on the IRS budget. We'll talk about the Inflation Reduction Act funding. And I thought it was a wild coincidence that President Biden's nomination for the new Commissioner of the Internal Revenue Service is going to be starting his confirmation hearings in front of the Senate as we speak today. So a little history on the IRS budget. In the last 10 years or so, the budget had been decreased substantially. As an example, there was a 43% decrease in the funding for IRS agents. Most taxpayers would applaud that. But stay tuned, because even though I always wore the white hat for my clients, and the IRS wore the black hat, I had concerns about IRS funding in terms of me being able to appropriately do my job to serve my clients. A tax gap was identified, meaning that a lot of unreported income was escaping taxation. It was estimated that had all that income been picked up and taxed, it would have raised $7 trillion over a 10-year period. That was very appealing to people because that would raise revenue for the government in lieu of tax increases. And it got attention because you may recall that in June of 2021, ProPublica had gained access to information on some of the wealthiest individuals in the US and showed that they were maybe not paying their fair share. From my perspective as a client service advisor, I found it incredibly frustrating that when I tried to contact the IRS on behalf of my client, and I even had special direct hotlines for tax practitioners, the statistics said that only 11% of those phone calls were being answered. Very frustrating. In the past year, Congress gave some additional funding to the IRS that got them back to 2010 budget levels. Then the Inflation Reduction Act came in with the big $80 billion budget increase. The buckets of that 80 billion, just short of 80 billion, I've got up here on the screen. Enforcement, sounds like a bad thing. It applies IRS exams, but again, it was intended to go after some of the unreported income. Operations support, just making the service run more efficiently. Anyone who has a business and lots of employees knows it's difficult to have enough to pay your employees well and to run your operation. IRS has the same issue. Systems modernization I talked about. We need to replace those old computers and hardware from the 60s. Taxpayer services would include helplines, access to support during filing season, and finally, a little bit there for tax court, so that tax court would have the ability to hear a broader population of cases. So again, this 80 billion was going to come into the budget over a 10-year period. A lot of facts and fiction out there when people hear about IRS funding. I'm going to show you some of the top ones. I'll give you what the fiction is and give you what I believe is fact. There have been rumors that 80 billion translates to 87,000 new employees, which would double the size of the IRS. Fact is, the IRS would probably only grow about 25 to 40%, and that would depend on attrition. Employers are all aware of the giant sucking sound for employees who are quitting their jobs as a result or during COVID. The IRS is also losing a lot of highly seasoned agents who, in some areas, you want a highly seasoned agent on other side of the table from you, or you'll be very frustrated working with an agent who isn't up to speed on what needs to happen. Fiction number 2, everybody that's hired will be put into the examination division. The fact is that the new hires will be spread throughout the organization. Fiction, these new hire examiners will carry guns and they will be knocking on your door in the middle of the night. Fact, of course, some new hires will be in the criminal investigations division. But for those of us taxpayers who think we are not doing anything criminal, we should be happy to think that the criminals will come to justice. Fourth fiction, examinations of taxpayers who earn less than $400,000 will significantly increase. The fact is, yes, examinations will increase, primarily on high net worth or high income individuals, also large corporations that are very complex and complex partnerships. And then finally, tomorrow, the IRS is going to be at your door, my door, in examination mode. Again, anyone who runs a business knows you don't bring new hires in without having a significant investment of dollars and time into getting these people up to speed. So it's going to take time for these new examiners to be able to be launched and actually get out into the field. The National Taxpayer Advocate is someone who is appointed by the president, approved through the Congress and so forth. This person is required to give a report to Congress every year. The report that we most recently received identified the 10 top problems the IRS is experiencing. And these are problems that affect us as taxpayers as well. Processing delays. Some people still haven't gotten their COVID refunds. Some people filed their returns over 2 years ago and haven't seen their refunds. The tax law is complex. We get it. They need to hire these people, but they have to find them first, then get them trained. They have to reinvigorate the telephone and in-person service that the IRS provides. Taxpayers and their tax professionals need to be able to have quicker online access to resources. If we want lower income taxpayers to file their returns, pay their fair share, we need to have easier access to e-filing and actually free filing through the IRS, so you don't have to pay a tax practitioner. People want to see more transparency. IRS is seen as a big black hole. Taxpayers want to know what's happening inside. A lot of people are running around preparing tax returns that have no business preparing tax returns. That's causing a lot of problem with processing, with not necessarily fraud, but errors in tax returns. So there needs to be a better way to have oversight of people who are out there preparing returns, whether they're paid or not. There need to be better ways for taxpayers to resolve controversy with the IRS. If you're examined, you go up through a food chain, appeals, and ultimately into the court system. There need to be easier, swifter, more efficient ways for taxpayers to go through the appeals process. And finally, a concern about taxpayers overseas, whether they're individuals. I had some clients who were willing to give up their US citizenship to get away from US taxation. And then, as I mentioned earlier, companies who are leaving US shores to save on corporate tax rates. Some of you may not be aware that the IRS has very broad regulatory authority. So Congress passes the laws, the statute, they legislate, but Congress passes laws that can be very broad on purpose to scoop in as many taxpayers and tax revenue as possible. They can also have some provisions that are so narrow that they block out taxpayers and businesses that were really intended to get the benefit. So under Section 7805 of the Internal Revenue Code, the IRS is given what's called general authority to interpret what Congress passed in terms of statutory language. Even beyond that, though, the IRS has the authority to write what are called legislative regulations. This is where Congress, and I'm going to use my own words here, Congress writes law with a concept in mind, but they don't have the time, energy, resources to be bothered with the details of application and implementation. So they simply hand it off to the IRS and say, here, you figure it out, prescribe regulations, and make this thing work. That's a problem if the IRS doesn't have enough resources. I think it's also a problem in that the people who then are really writing the law, if you will, are not elected officials. And is that too much power for the IRS to have? So what are the challenges the IRS faces? I think they're still pulling out from the recovery from COVID, catching up with the backlog. Although when people say, where's my refund? I've got some numbers there for you that show you the backlog has been cut by about 50%, depending on what category of tax returns you're thinking about. They need to implement this Inflation Reduction Act, the two brand new provisions we've never seen before. What is book income for purposes of applying the 15% tax rate. And then again, how are we going to define stock buybacks for purposes of the 1% excise tax? There's a backlog of regulations the IRS needs to be issuing. Some of them go back to the start of my career in the early to mid 80s. They've just been shelved because there's no time to get them done. And then as a business owner, if you realize you were going to get $80 million in funding, you know that would be an incredible job to figure out where to put it and how to most effectively use it. IRS has that issue to deal with as well. So what's the 118th Congress up to? I've got question marks because we have no idea. What I can tell you, and I'm sure this is not news to you, is that there will be legislative gridlock. As a result of the 2022 midterm elections, the Republicans gained control of the House. All tax bills have to start in the House. They can go to the Senate gets their own version, they compromise, it becomes law. The Democrats retain control of the Senate. So the chances of the House and Senate agreeing on something are pretty low. There are also two senators who are Democrats. Senator Sinema from Arizona recently announced she was going to change and become an independent, although she's, I believe, still going to caucus with the Democrats. But we know that Sinema and Manchin from West Virginia, which is a coal-producing state, has been a little bit of a stick in the mud in terms of getting some of Biden's legislation passed. So even though the Republicans have control of the House, the Democrats of the Senate, their razor-thin majorities are going to need Republicans to keep track of their own, the Democrats to keep track of their own as well. I won't begin to tell you that I understand all of the congressional rules in terms of bill passage. The filibuster, we have budget resolutions, continuing resolutions. I listen to it and wait till it's all kind of been resolved and we get what we get. Mixed into all this tax legislation, though, the economy, inflation, recession, all of that, Congress still needs to deal with government funding and raising the debt ceiling. So that's going to be piled on top of all of this tax discussion as well. There's a wish list by the Republicans. They want to repeal the Inflation Reduction Act. They want to extend all of President Trump's tax bill provisions that are going to start expiring here in 2025, 26, and so forth. I told you that some of them have already started to phase out in 2022, 2023. They want to keep a really close eye on what IRS is doing with the funding and potentially repeal some of those provisions. As I said earlier, the Democrats' holdout is they want to keep an enhanced or enrich the child tax credit. They want to continue to build on climate legislation and implement Biden's Build Back Better agenda. The AICPA, which is the American Institute of Certified Public Accountants, they have a wish list also, which I think is very interesting. They recently sent to Capitol Hill a 167-page document that summarizes 61 recommendations of things they think Congress should consider. I scanned through them very quickly, and unless I missed it, I was amazingly surprised that they're not recommending the elimination of the 15% corporate minimum tax on book income. Because when this was going through Congress, generally accepted accounting principles, GAAP, are what dictate financial statement accounting versus tax law, which determines taxable income. The AICPA sent a letter to Congress in August of 2022 and said imposing tax according to financial statement income takes the definition of taxable income out of Congress's hands and puts it into the hands of industry regulators. Public policy taxation goals should not have a role in influencing accounting standards or resulting financial reporting. So again, unless I missed it, it wasn't on the list. Two bills have actually already been introduced in the House. HR 23, called the Family and Small Business Taxpayer Protection Act. It repeals IRS funding. It does retain an increase for taxpayer service, and modernization of business systems. In addition, HR 25, called the FairTax Act of 2023, will eliminate income taxes, payroll taxes, and the estate and gift taxes in lieu of a national sales tax. The rate will be 23% beginning in 2025, and it will be adjusted going forward. There will be some exceptions, as there always are, for used and intangible property, property or services purchased for business, export, or investment, and also things that are purchased to support government functions at the state level. There will be something called the family consumption allowance. So based on family size and government poverty levels, certain people will get some exemptions or exceptions. What I find very interesting is that this bill would give all of the responsibility for administering, collecting, and remitting the national sales tax to the states. They would simply write a check to the federal government. The revenues would be used for general revenue, whatever that means, but there's also a separate bullet, which in my mind kind of encompasses what we currently know as Social Security and Medicare. The bill says the IRS will receive no funding after FY 2027, which I believe equates to the abolishment of the Internal Revenue Service. It also requires that the 16th Amendment to the Constitution be repealed within 7 years, or the act would be set aside. State income tax update very quickly. There were midterms. The states had COVID impacts, and there are some discussions about repealing state income taxes. So the midterm elections resulted in 39 trifectas. And what that means is that the House and Senate and governor positions are held by the same party. Republicans have 22 of those trifectas. That would imply that they are probably going to be interested in cutting taxes. 17 are held by Democrats, which could imply increased spending. There are no new elections in 2023, so until we get to the 2024 midterms and presidential election, we have what we have. The state budgets panicked when COVID hit, but amazingly, they've mostly come out very well with a couple of exceptions. They've had budget surpluses. They've actually cut personal and corporate income tax rates. They've given rebates for personal property taxes. They did some relief payments under COVID where they were handing money out to taxpayers to help them stay afloat. The IRS within the last few days has said that those payments received by taxpayers from their state governments will not be taxable. A lot of controversy for the last few days. What are they going to replace their funding with? Sales taxes, excise taxes, online sports gambling, legalization of marijuana are additional sources of revenue. But what about the pending recession that we're all hearing about? Inflation is still not under control, and people's investment portfolios still have not recovered. ARPA, one of the COVID bills, had a provision that if states received federal funding and ended up in a budget surplus, they would be prohibited from reducing state income taxes. That's going up through the court system because states are saying that is an unconstitutional law passed at the federal level. So repealing state income taxes, a couple anecdotal things here. I'm in Iowa. Iowa has recently lowered both individual and corporate rates. They have excluded retirement benefits from being taxed. And our governor, Kim Reynolds, was just noted in the press within the last few days as saying that by the end of her term in 2026, she wants all state income taxes to be repealed. My sister lives in Massachusetts. This won't affect her. She, I don't believe, has $1 trillion worth of net worth, but Massachusetts has gone the other way, and they've instituted what's called a millionaire's tax, a 4% tax on income exceeding $1 million. And this has prompted lots of discussions about people leaving Massachusetts and going north into New Hampshire. So where are we going to go going forward here? And then I will wrap up. In the State of the Union, President Biden dug in. He's going to stick with his Build Back Better plan. He thinks the 15% corporate minimum tax on book income is the right answer. He's talking about a billionaire minimum tax, which would be a 20% tax on net worth, not taxable income, but net worth. And then he's sticking to his guns that the IRS needs the funding that they've been given. If you're a business, 2022 into 2023, you better be doing lots of modeling or keeping 2 sets of books, because we don't know if Congress is going to step in and fix 2022 for these things that were starting to expire, the R&D expensing, the bonus expensing, and the limits on business interest deduction. Some businesses may extend their returns waiting for Congress. They might file their return and then do what's called a substitute return, completely replace it if Congress acts. They might have to file their return and then go back and amend the return. Publicly traded companies, high-tech companies are busy right now trying to get a handle on their financial statement income. And again, as I said earlier, this could be happening at a worse time if a recession is in fact going to happen and we are seeing rising interest rates. If you're an individual, 2022 returns into 2023, stay attuned to any electric vehicle credits that might apply to you. Look for child tax credit enhancements. Take advantage of the Secure 2.0 retirement plan changes. Keep in mind that the tax rate schedules are adjusted for inflation. And because inflation hit us big, we're seeing major raises in the level of income you have to have before your rates increase. So another way of saying that is people might find themselves over withheld or getting some nice refunds Student loan forgiveness. We had the moratorium during COVID. President Biden, by executive order, said he was going to forgive up to $20 million $20,000 in student loan debt. The Supreme Court is going to be having hearings yet this month on whether that is in fact constitutional. So we don't know where we're going to land on that either. And then finally, as we approach the 2024 elections, and I just see that Governor Haley put her hat in the ring. What happens? Tax 101 would say, if you think rates are going up, accelerate income at low rates now and save your deductions for higher rates. The C Corp rate of 21% is permanent at this point, but this could reinvigorate the whole discussion of whether you want to be a C Corp or a pass-through entity, because that QBI deduction is going to go away in 2026. And the big banana in my mind is estate planning. Again, if Congress doesn't act, the pre-estate tax exclusion amount is going to go from almost 13 million today, having been adjusted for inflation, back to 6 million. You can't make decisions about gifting and estate planning overnight. If you have an estate tax problem of this magnitude, you need to get busy now with getting a plan into place. And lastly, April 15th isn't April 15th this year. April 15th is Saturday, which means you get until Monday, but that's Emancipation Day in Washington, D.C. So the filing deadline is actually April 18th. When I was practicing, I thought, oh, I've got 3 more days, but my clients knew they had 3 more days, so it didn't really amount to a lot. So I just want to say, as I sign off here, good luck to taxpayers and their tax advisors this filing season.
Thank you, Kay, so much. It looks like we just have a couple of minutes to get to a couple of our questions. So the first question I have here is, why don't we just switch to a flat tax? Wouldn't that just simplify everything?
Good question. I get it all the time. And what I tell my students in my tax classes is there are 2 things to determine what your tax liability is, your tax base and the tax rate. And I tell them, and I'm being kind of flip here. It ain't about the rate, stupid. It's the tax base. What are you going to multiply the rate by? That's where the complexity is. And I also tell my students, tax law was originated in 1913. We've built it brick by brick, room by room, floor by floor, and we now have an ugly building that no one would ever build. But if you try to dismantle it at some of the lower levels and pull a brick out here and there, the whole thing is going to collapse. So it's just not as simple as going to a flat rate.
Awesome, thank you. Next question, how do you do your own tax return?
Good question. Well, when I was still a partner with my firm, I had to file in numerous states, blah, blah, blah. So I actually had someone within the firm that prepared my return with the data I gave them. I'm on my own now. I won't tell you that I use one over the other, but I have used TurboTax. I've used Tax Act. I don't qualify for the free file. I think they're all solid systems, but remember, garbage in is garbage out, and I will catch errors that I make, and I theoretically know what I'm doing. So it concerns me that people are maybe attempting to do this at home and they're not safe trying to do their own return.
One last question, is Social Security on the chopping block?
The tax bill that's been introduced at the House level that would get rid of income taxes and everything else in lieu of a national sales tax does appear to have some discussion in there that I would loosely title as Social Security and Medicare. I believe it was brought up during Biden's State of the Union. And I think, if I remember the stories right, he got everyone to clap on both sides of the aisle saying, no, we're not touching that sacred cow. But we'll have to see.
Awesome, thank you. Well, we are out of time today. Thank you, Kay, and thank you to everyone for attending today's webinar on tax planning in tumultuous times. When the event ends in just a moment, you'll see a quick 4-question survey. We'd be really grateful if you could share your feedback. It helps make our next webinar even better. On behalf of the Tippie College of Business, thanks so much for joining us this afternoon, and go Hawks.